Hey everyone, welcome back to the show. Thanks for tuning in. Happy Monday. My name is Mike. This is my whiteboard, and today we're going to be talking about financing spreads. And really, we're going to break down the whole concept of financing in general. It really applies to all things where there's a spread involved or multiple embedded positions, but we're going to talk about what financing really is, how it impacts our trading, and why we prefer it over getting long options or getting long spreads outright. So let's go to the first slide, and we'll talk about two main factors when we're talking about financing these spreads and financing in general. So what is the point of it? Well, the very first thing I want to point out is that it's going to reduce our cost basis of long spreads and options. So instead of just buying one long option outright, or maybe buying a long spread outright where we're definitely going to be paying a debit, we look to finance it by selling an out-of-the-money option or selling some sort of option spread maybe to finance that long spread and either reduce the cost of it or turn that debit that we normally pay for long options and long spreads into a credit, which is going to lead us right into turning low probability trades, which is anything where we're really buying something for a debit, and especially with long naked options where we're definitely going to have a lower probability of profit because not only are we paying a debit for it, but our break-evens aren't going to be the best. So anytime we can finance something, we're going to do better at turning those low pop trades into high pop trades. And I've got some things written here that I want to talk about. So when we're looking at reducing cost basis, really it's all about the mentality of just taking control of what we can and not worrying about what we can't. So instead of focusing on a long naked option where I might say I've got a really strong assumption on this particular underlying, so maybe I'm looking at buying a call naked. Well, I don't really know, even though if I might have a strong conviction that the underlying might go up if I'm buying a call, or that the underlying might go down if I'm buying a put, there's really no way to know that that's going to happen for sure. So one thing I can do is instead of buying that naked option, I can turn it into a spread. I can start financing that long option by selling an option against it. And it really goes to show that when we take control of what we know and what we can control, it's going to help us turn into better traders in the long run. And when we're looking at lower probability trades, like things like buying naked options or buying out of the money spreads even, when we're looking at low probability trades, it might work out one time or maybe 3 times out of 10, but over time, if we continually have those losses where we're not making these successful trades, it's going to turn this portfolio that we have into a losing portfolio much quicker than we would think. So let's really dig into reducing cost basis of long spreads and options on the next slide. And we'll talk about a few things that we really look at. So when we're looking at the reduction of cost basis, again, when we're looking at basically turning this long naked option into a spread, all we're doing is instead of buying this long naked option, which is definitely going to be a higher cost, because we're paying for, number one, the intrinsic value, which is just the value of that option at expiration, the real true value. So with calls, anything below the stock price will be considered in the money and have intrinsic value. And with puts, it would just be the opposite. So anything above the stock price would have intrinsic value and have real value at expiration. So especially when I'm buying an in-the-money call, I'm paying for that intrinsic value, which is just the difference between the stock price and the strike price, but I'm also paying for extrinsic value. I'm basically paying for the right to hold on to that option, and I'm paying to the tune of the time that's left on that option, as well as the implied volatility. So the longer time there is, the more I'm going to be paying for that option, and also the higher the implied volatility is, the more I'll be paying for that option because of that implied move to the upside or downside that lies there. But one thing I can do is instead of buying a naked option, regardless of where it is, whether it's in the money, at the money, or out of the money, I can spread it off and start to finance that long option by selling an out of the money call here. So in this example, instead of buying this long option here with no cost basis reduction, I'd probably be looking at maybe a probability of profit of 30 to 40%. But when I sell this option here, I instantly bring my cost basis down, and what that does is it moves my break even down further. So we talked about this long call and how it has intrinsic value and extrinsic value. Well, I know it has at least this amount of intrinsic value because it has to, but any extrinsic value that I'm paying for moves my break even out here. So basically, if I were to just buy that call outright, I would need the stock price to now move to my break even just to break even on the trade. But if I sell an option against it and I'm able to move my break even right where the stock price is trading, which is usually what we can do when we buy a spread like this, where we are buying the in the money option and selling an option just out of the money, we're able to move that break even down just a bit, or even ideally if we can bring it down just a little bit further than where the stock price is trading. Now I don't need the stock to move. I can have the stock be exactly where it is, and I'll break even or maybe make a tiny bit of profit if I'm able to bring that break even down by selling this out of the money option at a very nice value. So this concept can be applied to really any spread. When we're looking at any sort of spread, we're basically financing the long option with that short option sale. Because if you think about where the profit comes from, in this particular example, the profit comes from that long option. The profit doesn't come from the short option unless we sell this option and it brings our break even down below the stock price. That is the one case where this short option can actually result in profit because now the stock price doesn't have to move. But when we're talking about pure profit on this position, we don't make money on this option if the stock price goes up, but we do make money on this option if the stock price goes up, and we actually will be able to offset any losses we see here with the gains on this option. So really, when we're looking at how the concept of financing works and where the profit comes from, the long option is going to hold the profit potential when we're looking at spreads like this. So anytime we're able to reduce that cost basis, we're going to do so. And I've got an example here, which is a broken wing butterfly, where we're really just financing a short call spread with the purchase of a long call spread. That's really all it is. And that's exactly how that profit plays in. So when we think about the broken wing butterfly, and if we realize where the max profit is, which is right here, so if the stock price moves up to these short calls at expiration, we're going to be at max profit. And that's because we have a long call spread here. So I've got a call that would hopefully be in the money, and it would be financed by one of these calls. But if I were to just buy this call spread here, it would cost me a debit. It would cost me some money to pay for that. But since I'm selling a call spread here, where I've got one short spread here, or one short option here, and one long option here, and you can see that this one is not equidistant. This short spread is much wider, so I'm able to collect a credit that's greater than the debit I'm paying for this much shorter call spread. But since I can route that for a credit, basically all I've done is I've taken this short call spread here and I've completely financed the purchase of my long call spread by this short spread here. So that's how a broken wing butterfly works, and we instantly turn a usually low probability trade into a much higher probability trade, because now if I'm able to route this for a credit, I don't need the stock price to move at all. If I can route this for a 20-cent credit or maybe a 15-cent credit, then the stock price can go down, which is obviously not what I want it to do. I want it to be right at this strike at expiration. But if I route it for a credit, it no longer matters. I can have the stock price go down. I can have it stay the same. All these options can expire out of the money, and I'll still be profitable by that 15 or 20 cents or whatever I collected. But not only does financing help us reduce our cost basis, it's also going to improve our probability of profit. So let's go on to the next slide and we'll talk about that a little bit. So one thing we need to point out is when we're looking at spreads, so now I've just reversed it. I'm looking at a long put spread here, whereas before we were looking at a long call spread. We're going to be dealing with about a 50-50 shot. So anytime where I'm buying an in-the-money call and I'm trying to sell, or I'm sorry, buying an in-the-money put and selling an out-of-the-money put where the strikes are pretty equidistant, what's going to happen is I'm probably going to be left with about a 50-50 shot, because I've got an in-the-money put here, selling an out-of-the-money put here. My break-even should probably be right where the stock price is trading, which ultimately leaves me with a 50-50 shot. But one thing I want to point out is that I'm going to be paying a debit for this. So what are some ways that I can reduce that debit and bring it down to a credit? All we need to do is, if I know that zero is here and I'm paying a debit up here, I can sell options or an option against it to hopefully bring this debit down into the credit range. And anytime we have a spread or any sort of options trade that we route for a credit, we give ourselves a lot more opportunity to be correct. So here, instead of just buying this put spread, what I could do is ultimately sell another put against it, take on a little more risk, and turn this spread into a credit. So now, instead of paying for my long put spread here with a debit, I'm able to sell another put. Maybe this put is in the next expiration or whatever we need to do to turn this debit into a credit here. I'm going to have a much higher probability of success because now if I'm routing this trade for a credit, number one is that the stock price can actually stay the same and I'm going to be even more profitable because if I can route this sort of spread for a credit, at expiration, both of these options are going to expire worthless, but I'm going to be left with an in-the-money put here. So let's say this put is $2 in the money, and I was able to route this entire trade for a credit. If the stock price is pretty stagnant, maybe it moves down, maybe it moves up a little bit, but at expiration, if the stock price is here, both of these options are gone. I've collected the credit already, and that can be turned into profit, but I'm left with an in-the-money put that's, let's say it's 2 points in the money, that's going to be worth $200. So now I've routed a strategy for a credit, and at expiration, even if the stock does not move at all, I'm able to profit from that, and that's why this strategy would have a much higher probability of success. I don't need the stock price to move directionally, which is exactly what I need here. And in here, I've got so many ways to be profitable, I can't even count them. So when I'm looking at a strategy like this, when we're looking to reduce the cost basis and finance it with the sale of another option, that's when we're really getting into those high probability trades, which is exactly what we're looking for. So let's wrap all this together with some takeaways for you. Very first takeaway we've got is that you can apply this to any sort of strategy, whether you're looking at just a call spread or a put spread or something more complex like a broken wing butterfly. Anytime we're looking at financing a long spread with the sale of a short option or a short spread, so with the broken wing butterfly, we've just got a long spread financed by a wider short spread, or in something like a Super Bowl, we're looking at selling a put and buying a call spread at the same time, but usually that put offsets the cost of the call spread, which is why it's considered that Super Bowl. We're still turning these trades into higher probability trades, and we're reducing the cost basis overall. And last but not least, we always want to focus on what we can control. Although we might have a really strong assumption directionally, it's not going to be guaranteed. But what is guaranteed is our cost of entry on the trade. So anytime we can reduce that and bring that down to ultimately improve our probability of success, we're going to do that, which is why you always see us looking to finance our spreads or at least spread off any sort of long option strategy we want to get done. So thanks so much for tuning in. If you've got any questions or feedback, shoot me an email here, or you can follow me at DogeCarterMike on Twitter. Stay tuned though, we got Jim Schultz coming up next.